The past week will be etched in the memories of investors as one of the most volatile in recent memory. Global equities saw trillions wiped off their value as Trump's tariff policies sent shockwaves through the financial markets. The Dow Jones Industrial Average, after experiencing four 1,000-point swings, managed to close the week up 1.56%. The S&P 500, despite falling 17% from its record high 7 weeks earlier, ended the week with a gain of 5.7%. The tech-heavy Nasdaq Composite, fueled by strong performances from giants like Nvidia and Amazon, surged by 7%. However, this roller coaster ride wasn't confined to the United States. The MSCI All-Country Index, a broad gauge of global equities, entered correction territory, signifying a 10% drop from its recent peak. Japan's Nikkei index also felt the heat, dropping 4% midweek. The CBOE Volatility Index, also known as the market's fear gauge, spiked above 60, reflecting the heightened anxiety gripping investors. Jeff Wilson, a prominent investment strategist, summed up the sentiment, noting, "Market confidence has been fractured. Investors are grappling with uncertainty on multiple fronts." At the heart of this market turmoil lies the escalating trade war between the United States and China. President Trump's decision to impose a 10% blanket tariff on all imports, with rates escalating to 145% on certain Chinese goods, sent shockwaves through global supply chains. China, in retaliation, imposed tariffs of up to 125% on U.S. imports. This tit-for-tat tariff battle brought trade between the two economic giants to a near standstill. The ripple effects were felt far beyond their borders, impacting businesses and consumers globally. The Treasury Secretary, while reporting that over 70 countries were in talks to negotiate trade deals to circumvent the tariffs, expressed doubts about reaching agreements within the 90-day window set by the administration. Adding to the market's woes, the usually stable bond market experienced its own share of turbulence. U.S. Treasury yields surged dramatically, with the 10-year yield jumping nearly 20 basis points in just 2 hours, reaching above 4.5% by Friday. This marked the heaviest selling of U.S. government bonds in decades, raising concerns about their status as a safe haven asset in times of uncertainty. The 30-year yield also saw its most significant weekly surge since 1982, indicating growing investor unease. This flight from safety in the bond market further fueled the volatility in equity markets, as investors grappled with the prospect of a slowing global economy coupled with rising inflation. The combined impact of the trade war, market volatility, and rising bond yields has pushed the global economy closer to the brink. Prominent economists have sounded the alarm, with J.P. Morgan and Goldman Sachs estimating a 50% chance of a recession in both the United States and globally. BlackRock CEO Larry Fink went even further, suggesting that the U.S. might already be in a recession. Consumer sentiment, a key indicator of economic health, plummeted to its lowest level since 2022, reflecting the widespread anxiety among consumers. Inflation expectations also soared, with one-year inflation expectations reaching 6.7% and long-run expectations hitting 4.4%, the highest level since 1981. This perfect storm of negative economic indicators has left policymakers and investors alike scrambling for answers in these uncertain times. Please like, subscribe, and share this video on YouTube.